Hello everyone. This video will take you through sales on account or credit sales and estimating bad debt expense in uncollectible accounts. Gulf Coast Consulting is a new company. The company follows generally accepted accounting principles or GAAP and uses accrual-based accounting. All services provided are an account and payment is due net 30. That is within 30 days. The percentage of accounts receivable method is used to estimate uncollectible accounts and bad debt expense. The company records adjusting entries on a quarterly basis and has a December 31st year end. For each quarter, you've been asked to 1. Account for the credit sales and cash collections. 2. Use the percentage of accounts receivable allowance method to determine the adjusting entry. 3. Journalize the quarterly entries and post the amounts to the general ledger accounts. And 4. Determine the amounts to be reported on the balance sheet and the income statement. For this problem, we'll have a chart of accounts that includes 4 accounts: accounts receivable, allowance for uncollectible accounts, frequently abbreviated as AUA, service revenue, and bad debt expense. For each quarter, you will be given information relating to consulting services provided on account, cash collections on accounts receivable, customer accounts written off, and the estimated uncollectible percentage to be used to determine the target balance in the AUA account. Customer accounts written off refers to the process of removing a specific customer's accounts receivable balance from the company's books because the company has determined it will not be collected. So let's take a look at our operating results quarter by quarter. Our first step will always be to complete our calculations. During the first quarter, our consulting services provided on account were $400,000. Our cash collections on those accounts receivable was $300,000. There were no customer accounts written off. Our ending balance in accounts receivable is going to be $100,000. Because we're new, we had zero balance in accounts receivable to start off. We added $400,000 from our services provided on account, and we subtract $300,000 for cash collected on those accounts receivable. Ending balance in accounts receivable, $100,000. Now, GAAP requires that we estimate our uncollectible amounts each reporting period. That estimate is referred to as our target balance for allowance for uncollectible accounts. Because we're using the percentage of accounts receivable method, to get that target balance, we'll take the ending balance of accounts receivable and multiply it by our AUA percentage. The estimated uncollectible percentage for this company is 2%. That determination is made by the management team based on historical trends and industry standards. We take that 2%, we multiply it by the ending balance of $100,000, and we get a target balance of $2,000. The bad debt expense reported for the period is the amount that'll take our prior balance in AUA, which is zero, to $2,000. For the first quarter, it's $2,000. Now let's take a look at the journal entries. The journal entries for Q1, January through March, are first to record the revenue. We'll debit accounts receivable for $400,000, credit consulting fees revenue for $400,000. Then we'll record our cash collected, To record our cash collected, we'll debit cash for $300,000 and credit accounts receivable for $300. Finally, we'll record our adjusting entry needed for bad debt expense and to update the AUA account by debiting bad debt expense for $2,000 and crediting the allowance for uncollectible accounts, or AUA, for $2,000. Now let's take a look at our general ledger, which resembles T accounts. Our accounts receivable is an asset. As an asset, it has a debit balance of $100,000. The debit postings exceed the credit postings. Allowance for uncollectible accounts has a balance of $2,000, but because the allowance for uncollectible accounts is a contra asset, it has a credit balance. Consulting fee revenue has a credit balance of $400,000. Revenues always have credit balances. And bad debt expense has a debit balance of $2,000. Expenses always have debit balances. When we look at the impact that the first quarter will have on financial statements, you'll see that our income statement will record $400,000 in consulting fees. And because it's our first quarter, the year-to-date will be $400,000. Our bad debt expense for the quarter is $2,000. And because it's our first quarter, the year-to-date is $2,000. On the balance sheet, we will show accounts receivable at $100,000, the AUA, or allowance for uncollectible accounts, at $2,000, and our accounts receivable net at $98,000. The balance sheet amounts are always a snapshot at the end of the accounting period. The AUA, because it's a contra account, is always subtracted from the ending balance of accounts receivable to get the net accounts receivable. Net accounts receivable is also called the net realizable value for accounts receivable. Now let's take a look at the second quarter. During the second quarter, consulting services provided on account totaled $500,000. Cash collected on accounts receivable totaled $450,000. There were no customer account write-offs. Estimated uncollectible percentage remained at 2%. So let's do our calculations first. Let's determine accounts receivables ending balance. The accounts receivable ending balance is the prior period's balance of $100,000 plus the consulting services on account of $500,000 minus the cash collection from customers on account of $450,000. We have an ending accounts receivable balance of $150,000. The target balance for our AUA account will be the ending balance in accounts receivable times the estimated uncollectible percentage, or 2%. $150,000 times 2%, $3,000. Finally, we'll determine our bad debt expense. In this case, our bad debt expense is not $3,000 because we already have $2,000 in our AUA account. The bad debt expense for any accounting period is the amount needed to take the prior balance in the AUA account to the targeted balance for the current period. So since we were at $2,000 at the end of Q1 and we need to get to $3,000 in Q2, our bad debt expense for the period will be $1,000. The journal entries for Q2 are similar to Q1. We'll debit accounts receivable for $500,000 and credit consulting fees revenue for $500,000 to record the revenues for the period. will debit cash for $450,000 and credit accounts receivable for $450,000 to record the collection of cash on account. Our adjusting entry will be a debit to bad debt expense for $1,000 and a credit to the allowance for uncollectible accounts, or AUA, for $1,000. With the journal postings to the general ledger, all four accounts are updated. Accounts receivable now has a debit balance of $150,000. Allowance for uncollectible accounts has a credit balance of $3,000. Consulting fee revenue has a credit balance of $900,000, and bad debt expense has a debit balance of $3,000. For Q2, the income statement will show consulting fees of $500,000 with a year-to-date total of $900,000. It will also show bad debt expense for the quarter of $1,000 with a year-to-date total of $3,000. The income statement will always show a quarterly amount and a year-to-date total. The balance sheet, a snapshot at the end of Q2, will show accounts receivable at $150,000, AUA at $3,000, with a net accounts receivable of $147,000. The third quarter shows a downturn in the economy. Consulting services provided on account are $300,000. Cash collections on accounts receivable are $200,000. During this quarter, we have a customer write-off for $5,000, and we keep our estimated uncollectible percentage at 2%. The ending balance for accounts receivable will use the Q2 balance of $150,000, add the services provided on account of $300,000, subtract the $200,000 in cash collections, and subtract the customer write-off of $5,000 to get a balance of $245,000. When a specific customer is written off, the amount of the write-off is always deducted from both accounts receivable and the allowance for uncollectible accounts. The target balance for AUA will then be the $245,000 ending balance for accounts receivable times the 2% AUA estimated percentage, or $4,900. To get our bad debt expense for the period, we need to take the Q2 balance in the AUA account for $3,000. We need to subtract the $5,000 account that was written off during the period. That gives us a debit balance in our AUA account of $2,000. To reach the target balance of $4,900 credit, we need to add the two amounts together. $2,000 plus $4,900 equals a bad debt expense for the period of $6,900. For Q3, July through September, we have 4 journal entries that need to be made. First of all, to record revenue, we'll debit accounts receivable, credit consulting fee revenue for $300,000. Second, to record the cash collections, we'll debit cash for $200,000 and credit accounts receivable for $200,000. To record the customer write-off, we debit the allowance for uncollectible accounts for $5,000, and we credit accounts receivable for $5,000. The adjustment to record the bad debt expense for the period is a debit to bad debt expense for $6,900 and a credit to allowance for uncollectible accounts, or AUA, for $6,900. When we look at our general ledger account for accounts receivable, you see that during the quarter we debited accounts receivable for $300,000 from the revenues that we had earned. We credited accounts receivable for $200,000 for the cash collected, and we credit accounts receivable for $5,000 for the customer write-off, giving us a debit balance of $245,000. When it comes to the allowance for uncollectible accounts, you can see that during the quarter when we debited the allowance account for $5,000 for the customer write-off, the allowance balance changed to a negative $2,000. A negative $2,000 means the allowance accounts now had a debit balance. Once we post the adjusting entry of $6,900, our allowance for uncollectible accounts has a credit balance of $4,900. After the adjusting entries take place, the allowance for uncollectible accounts always has to have a credit balance. Consulting fees during the quarter were credited for $300,000, giving us a year-to-date balance of $1,200,000. Bad debt expense was debited for $6,900 during the quarter, giving us a year-to-date debit balance of $9,900. When it comes to the financial statements, the income statement will show consulting fees for Q3 of $300,000 and year-to-date of $1,200,000. Bad debt expense will show $6,900 for quarter 3, with year-to-date of $9,900. On the balance sheet, at the end of quarter 3, we'll show accounts receivable of $245,000, an AUA balance of $4,900, a net accounts receivable of $240,100. Let's look at Q4. During the fourth quarter, consulting services provided on account totaled $310,000, cash collected $300,000, no charge-offs, and the estimated uncollectible percentage remained at 2%. So when we do our calculations, our ending balance for accounts receivable is the $245,000 from Q3 plus the $310,000 revenue from Q4 minus the cash collected of $300,000 from Q4 for an ending balance of $255,000. The target balance for the AUA account is $255,000 times 2%, or $5,100. The balance in the AUA account at the end of Q3 was $4,900, so we need another $200 to get to the target balance of $5,100. When it comes to our journal entries, we're going to debit accounts receivable for $310,000, credit consulting fee revenue for $310,000. We're going to debit cash for $300,000, credit accounts receivable for $300,000. And for our adjusting entry, we're going to debit bad debt expense and credit allowance for uncollectible accounts for $200. When we look at our general ledger accounts, you can see that at the end of Q4, our accounts receivable balance is $255,000 debit. Our allowance for uncollectible accounts is $5,100 credit. Our revenue accounts for the quarter were $310,000. Our year-to-date balance, $1,510,000. Our bad debt expense for the quarter, $200. Our year-to-date balance, $10,100. When we look at the financial statements, the income statement will show that quarter four had $310,000 of revenue. Year-to-date, $1,510,000. $200 in bad debt expense. Year-to-date, $10,100. The balance sheet will show that at the end of Q4, the balance in accounts receivable was $255,000. The AUA account had a balance of $5,100, so the net accounts receivable is $249,900. To wrap things up, realize that every accounting period follows the same routine. Our calculations include the credit sales, cash collections, and customer write-offs to determine the ending balance in accounts receivable. Multiplying that balance by the estimated AUA percentage to determine our target balance for the allowance for uncollectible accounts. The bad debt expense is then the amount needed to take the prior AUA balance to the current target balance. Once the calculations are completed, the entries are journalized and posted to the general ledger to update the accounts so that the financial statements can be prepared. Thanks for taking time to watch this video. I hope this helps you better understand credit sales, accounts receivable, and uncollectible accounts. Good luck.